To tell us more about what's making headlines in finance and economic news this week, we're speaking with Suzanne Haddan, Managing Director of BFG Financial Services. Thanks for coming in.
Good morning.
So, quite a good bounce back on Wall Street. Did people jump the gun?
I think people are very resilient, or should we say hopeful. I mean, you look at the week in review and we had drops on the US, about 5%, and our own market, also 5%. I think the comforting thing is we haven't reached correction or crash territory, but there's certainly some risks existing.
So you wouldn't see this as a correction, because there were some people saying that this was the correction we had to have. Was it?
Well, a correction is technically a 10% drop, so it's a relief we haven't reached that point. I think the market has been fairly overheated, and I get surprised that we say the market's dropped because of the interest rates going up, which is true, but it's not as if the US Federal Reserve, which is like our Reserve Bank, hasn't warned us all that that's what they intended to do. They are doing what they said they would.
So people should have been factoring that in, you're saying?
I think they should have been factoring in, but we also need to remember for every drop there's certainly negative impacts, but it's also an opportunity. When you invest in shares, you do so accepting volatility. Returns aren't linear, they are like this. So volatility is a normal aspect of investing in the share market.
We saw US President Donald Trump coming out to attack the Fed Reserve. What impact did those comments have?
Well, I think the market would be hoping he has some influence, but the Federal Reserve's in a very difficult position. If they raise the rates too quickly, they'll dampen economic growth. If they do it too slowly, the economy will overheat. They've already raised rates 3 times this calendar year and looking to raise them again in December. And I think Donald Trump is really trying to disrupt once again. He kind of has to look at his own behaviour for the effect on the share market. There's a couple of things share markets dislike. One is trade wars, and I don't think he can blame the Fed for that. And the second is interest rates. Because when interest rates go up, bonds go up. The return on risk-free government bonds are at 3.2% for the US. So people say, risky shares, I can get a 2% dividend in the US. I could swap over to government secure bonds in this nervous time and get 3.2%. The outcome is not surprising.
You mentioned the trade war. Just how much is that playing on investors' confidence, and how long does it potentially have how long could it potentially wreak havoc, I suppose?
It's like this journey we're on. We keep thinking, no, President Trump will not do something else. And then President Trump does something else, like another 300 billion.
Yeah.
And so it's us accepting the reality of what he's going to do. Markets are driven by sentiment, so we can take time to accept the reality of the situation and the effect that the trade war has on global growth, global GDP, is bound to be negative.
It doesn't seem like the trade tensions will be easing anytime soon. So looking ahead to the future, what do you see on the markets there?
Well, volatility is nowhere near it was for the global financial crisis back in 2008, so we can take comfort from that. But we do see risks increasing, and you need to protect yourself. If you're a working regular investor in your superannuation, this is an opportunity because you're buying investments at cheaper prices. If you're living off your money, say a retiree, make sure you're taking some of the money off the table that you might have invested and park it so you can meet your living expenses in the next few years without selling at low prices. That would be my tip.
On volatility, obviously Australia is impacted not only by the United States but by Asia as well, so we're sort of right in the middle of it. And I think the Reserve Bank had some warnings yesterday about just how Australia might fit in if that trade war kind of blows up further.
That's a good point, Nick. We are not insulated. China affects us, our major trading partner, and there's some concern with their increasing debt that they might have trouble reaching their, 6.5% growth target, which is phenomenal. That will certainly impact us. So the Reserve Bank has warned us a couple of things offshore, being the trade wars, being the debt levels around the world, but they've also warned a couple of things onshore, and that relates to our debt levels and also housing You're noticing the housing is dropping. It's dropped over the last 12 months. And it's getting difficult to get a loan. And that's for a couple of reasons. The first is the rules tightening for what we really spend for living expenses on the measurement for a loan application. And the second is the Royal Commission is really focusing the banks on, improving their behaviour.
And the Royal Commission, the RBA rather, was also saying that the Royal Commission will essentially be good for the banking system because it will create a more resilient system.
We're on a long-term program, so I agree with the Reserve Bank that it will improve things long-term, but there's speculation that it will cost the banks $2.4 billion to remediate their customers who have lost money from their bad behaviour and revamp their compliance systems to meet the regulations. That's a huge whack, $2.4 billion.
A lot of these things obviously come down to psychology to some extent too. What do you think it does to people out there in the community when they're hearing what you're saying this morning, that, home prices are dropping? What does that do to their confidence and their willingness to open the wallet and spend?
Well, I think the first thing is if you're a first home buyer, you're going, yay, getting to my space. And interestingly, first home buyers, they have dropped off borrowing about 10%, but investors about 20% for loans over the last 12 months. But it will affect spending because also we're worried here about interest rates going up on our loans and having to find more money to meet our own repayments. So that Christmas will be a very telling sign, won't it, what we all spend around the Christmas period.
And just briefly and finally, Suzanne, the ATO had some new data on lost super. What was that telling us?
Does that completely do your head in?
Yeah.
That there's over $17 billion sitting around in lost super. One account was 2.2 million.
Oh my
Don't know
gosh.
how you could lose that, for goodness sake. But my tip is stop checking your lotto tickets, get onto the ATO website and check your super.
You might just win the lottery.
You might.
I think anyone who can afford to have $2 million just sitting there probably doesn't deserve it.
That's your take. All right. Thanks for that, Suzanne.
Thanks
For coming in.